Hello everyone. Welcome to today's Practitioners Insights webinar on Indian banking at the crossroads. All is well, or are we waiting for the next crisis? Hosted by CFA Institute. First and foremost, a very warm welcome to our audience joining us from around the world today for this interesting and insightful webinar. I am Pankaj from CFA Institute, and I will be the moderator for today's event. I lead capital market policy for India at CFA Institute, and in my role, I am responsible for advocating policy positions on issues that affect Indian capital markets. Before I introduce our speaker for today, I have a couple of housekeeping notes. First of all, today's webinar is scheduled for 60 minutes. First, we'll have some questions for our speaker. Don't worry, there will be some difficult ones as well. And then we'll have questions from the audience, which will be taken up by the speaker we have. So effectively, we'll be having enough time for Q&A. Please feel free to send across your questions and use the link which you have in the bottom. And we'll try to take up as many questions as possible. I also want to highlight that we are eager to receive your feedback, and we listen to it very attentively and try to incorporate your suggestions and your inputs very, very diligently. So if you have anything you want us to cover, or if you have any other points regarding these events, please let us know. This is not just helpful for us to improve these events, but also will be making these events more useful for you, the audience. In short, we immensely value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speaker for today, Pankaj Agarwal, CFA. Pankaj is co-head research at Anand Rathi Institutional Equities, and he has more than 2 decades of experience in institutional equities. He has been tracking the Indian banking and financial service sector for more than 20 years, covering a wide range of Indian banking stocks, NBFCs, stockbrokers, insurance companies, the entire range of BFSI you have. Previously, he also worked with organizations like Ambit Capital, Citigroup, and also with the market regulator SEBI. He is known for his deep fundamental research and has been a highly rated banking financial services analyst for almost a decade. He holds a Master of Management Studies in Finance from JBIMS, Mumbai. A very warm welcome, Pankaj. And I know that you are not well, but once again, thank you so much. And we appreciate that you have taken out time for this event. We hope speedy recovery. But once again, thank you so much for attending this event and joining us today. And I am sure
Thank
that
you.
our audience is eagerly looking forward to this event and will have a great experience listening to you. So without further ado, let's begin. Welcome to you, Pankaj.
Thank you. Thank you, Pankaj. Thank you for hosting me.
So let me begin with something which is personal. And I am asking the question because a lot of people in our audience may also be interested in understanding your background story. How and when did you decide to become an analyst? What attracted you to the market? And even more importantly, what sustained that interest?
I think, to be honest, I mean, initially it was just, I would say, luck or just chance. Uh, 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 I got into the markets because I started my career with SEBI in 2003, worked there for a couple of years. And then for some reason, my wife decided not to work. And in PSU salary, it was not easy to run my house. So, I came out with a number that this is the number I need to survive in Mumbai. And I looked into all the direction, whether it's, capital markets or, I even applied for roles like EA2, CEO, those kind of roles. And at that point of time, Citi was setting up their offshore research. So they were looking for associates in Mumbai who can assist analysts in UK or USA, and they were offering me the money which I needed actually at that point of time. So yeah, that was the reason I got into it. uh, I think initially I would say initially 4 5 years it was just mostly money, or I would say lack of options. But yeah, after 4 or 5 years working in this industry, I started liking it. I would say that from 2010 onwards, it was very conscious choice to be in the markets. Uh, First 5 6 years, it was just, I would say, as I said, just a coincidence that I ended up in the markets.
I think I love the honesty and I would say the candid admission on your part, and I would expect that the same transparency will continue to hold true in more difficult question, which will be coming your way, Pankaj. So
Sure.
thank you so much. And to be honest, like I was just joking, but to be honest, I think it shows the humility with which you explained the rationale and how did you get into the markets. But I think it's again a very difficult choice at times because you said whatever you said, but it takes a lot of effort. So like you just need, of course, need to put in long hours, but you also
Yep.
need active interest, commitment, and a keen desire to learn more, because that is something which, unless you do that, an analyst will not be successful analyst and you will not be able to sustain yourself in the market. And the way you have done in last almost 10, 12 years, 15 years, that like you have been a rated analyst, you are like recognized with all the key institutions across the board. So like what led to that interest? Of course, you can, as you explained, that you got into the markets because of chance and because of like what you wanted at that point in time. But what led to a sustained interest? What led to you continue to do a very important thing in terms of how you want to operate and how you want to learn more? So what happened? What happened in that?
I think it was I loved problem solving right from the beginning. In the sense, I used to like riddles, mathematical puzzles. So in a way, this market offered me, the similar kind of excitement, right? Like there is a stock, there is a business where I need to analyze whether this business will do well or whether this business will not do well. Even if it will do well, whether it's already priced in or not, right? And because of that, and if you look at the kind of clients you are serving, right, most of them know more than you. When you start your career, most of them know more than you. So it's quite intellectually challenging. It's not like as if you learn something and you have mastered it. One day you know that, okay, I've learned enough, and next day some very senior client comes and decimates you, right? And that kept me going, right? That desire that I need to be best at this work, right? That was the initial part. I think initially that that you are interacting with very very talented people, and they are challenging you on each and every day, right? Once you thought that, okay, I know this business quite well, and somebody tells you that, hey, you don't know anything. This is how this business has evolved in some other countries, right?
Right.
You come back to desk and you learn again, you go back again, right? So that process, that feedback process was always there in this business, right? If you
Right.
keep on getting feedback on your work, and if you keep on working on those feedback, you keep on improving, right? So that was, I think, one part. Second, I think a lot of traveling was involved. I mean, you travel across the world, and coming from the background, middle class background, I had hardly gone outside India. I think I had not gone outside India before I started working. Let alone that, I had not gone to any part, anywhere else apart from my hometown in Mumbai, where I did my studies. So that was another exciting part, where every 3 months you are either going to USA or UK or Singapore, all those countries. So that was another exciting part. So initially those 6 7 years, and then I think later, last 5 or 6 years, it was pure, I would say, my curious nature. I just wanted to learn even minute aspects of banking. So when I was done with this recognition part, where that client appreciation was, I mean, yeah, it used to give me high, but it was no more, that important. The traveling, I was almost tired by the time COVID arrived. I had started avoiding travel. But the last 4 5 years, it was new aspects of the banking, right? Fortunately, fintech was a buzzword during COVID. Paytm and a lot of these new businesses came, so there was something new to learn about the sector. There are something new to analyze, right? So some new challenges kept on coming. Some aspects which I thought I know quite well, and I realized that I didn't know. So, for example, despite being a banking analyst throughout my career, I believe that it's deposits which create loans, right? It's only at the later part of my career I realized it's other way around, right?
Yeah.
And I just stumbled upon it, just during COVID, I was sitting idle and reading credit creation theory. So yeah, as I said, various aspects kept me, going in this business. But one aspect I think I would say, if there are a lot of young audience, that if you are curious, if you're curious, I think this is the business to be in. I mean, if you're not curious, then it's very difficult to survive. Because if you're not curious, you will not learn, you will not read. And if you will not learn and you will not read, you will be outdated very soon in this business.
I think this reminds me of like I don't know how many people are watching Bollywood movies, but there is something which Manoj Bajpayee said, that like he said that if you think that you're coming to this business for uh, great opportunity to travel, make a lot of money, and everything else. Don't come to this business, because just 1 out of 100 people will do that. I don't think that it's that bad in analyst community, but still, what you said is spot on in terms of how uh, what are the motivation and what are the drivers. And I think that leads to another question from me, and probably the last one before we start discussing banking. At what point did the imposter syndrome go away, or is still there? That like at times I think a lot of people, because intellectual stimulation and intellectually challenging conversations, all those things sometimes lead to those questions about yourself, that whether you are right for this role, whether that was there in the early part of your career, or like is still there at some point when you meet some of these big people, I would say.
No, I think at some point of time, you realize, right? I mean, I won't say when it happened with me, but I think I would say that for me that was more around, I think, demonetization, right? Where till demonetization, as I said, most of my calls were going right, and I was traveling and everything. It that imposter syndrome, and then we took a big negative call on the economy during demonetization, and we were completely wrong as a house when was it with Ambit. And that's where my second inning started, where I realized that no, it's actually about analysis, understanding businesses. The rest is just, so social, right? So, yeah, I mean, that moment comes for a different point of time for different people. But for me, it was around demonetization, where I thought I know everything about these businesses, and I was completely wrong. So that changed everything, actually.
I think that's amazing, Pankaj, because I believe that like the way you have described this entire thought process and how it evolved, I think a lot of people would uh, like it would resonate with a lot of people in the audience, and probably a lot of younger people, as you rightly said, that for them it's important to keep that in mind, that you need to reinvent yourself at different points. Otherwise, you will get your thinking will get stale, and you will not be able to sustain your interest in the market and desire to learn more. I think that's fantastic. Moving on, Pankaj, like you have seen the banking sector for so long, I would say that for so many years, and it has undergone so much of transformation. For example, let's say when we look at early 2000 or even before that, like what is that you think that has changed, and what is that you think is still constant, is not changing, and how do you think investors should view it now, and which are the top 3 or 4 things? Of course, we'll come to the stock analysis part in banking, but when you look at this sector, what are the 3 or 4 things which you think that investors should keep in mind, and they should definitely focus on them before everything else?
So I think the key thing which has changed in the sector is that composition of the balance sheet for the banks has completely kind of changed in the last 15, 20 years. So when I started my career, industrial credit used to be a dominant part of the balance sheet, roughly 40% corporate credit, which we call. And over the years, retail has become a bigger part of the loan book for the banks. So industrial credit, which used to be roughly 40%, has come down to 22% now. Retail has gone to around 35%. So that is one mega change which has happened. Second, purely from a balance sheet, capital ratios have improved for bank tremendously. So post Lehman crisis, I think across the globe, banks have been asked to keep more capital on their balance sheet. So clearly, balance sheets of the banks, so especially capital levels, are very, very high compared to when I started. Liquidity requirements have gone up for banks in last 10-15 years, so they need to keep more money on the balance sheet. So yeah, these are the two three things which have happened on the balance sheet side. Apart from that, I think definitely the dominance of PSU banks have come down over the years. Licensing is easy, so we have seen more new banks coming into the picture in the last 10-15 years. uh, uh, yeah, technology has changed a lot. So when I started my career, we used to track number of ATMs, number of branches. Of course, now we track number of UPI transactions, net transactions, RTGS transactions. So the metrics which used to drive value for you, clearly those matrices have completely changed in the last 10-15 years. Yeah, some of the things still remain the same. I mean, I would say still the underwriting, quality of underwriting is still the one single most factor which it determines long-term profitability for a bank. That was true even in 2005, and that is true even in 2025. Low cost of deposit, which used to be the key driver of profitability, that was true in 2005 as well. That is true in 2025 as well. Quality of management, because it's not a business where you have any patents or any unique product, like where you announce the product or there is a queue outside your branch like iPhone 17. Right? It's not like that, right? Tomorrow HDFC Bank will launch a new loan, and tomorrow people are lining up from 12 a.m. It's not like that, right? So it's all about processes, systems. So those things are still same, and I don't think they will ever change. So yeah, some things have changed, something will not change. I don't think will change ever, actually.
I think, like when you talked about that industrial credit, I think a lot of people in the audience may not even know that the like how ICICI Bank evolved from ICICI and what was the full form of ICICI. Like I think it immediately reminded me of that. But anyway, like we'll move on. I think one thing which you mentioned, like this entire shift, because all these large private sector banks, they came into being around early 90s, and that's when like you had economic liberalization as well. A lot of things happened in terms of the growth of economy, for example, entire IT sector. And
Yeah.
what has happened, I would say that for a long time, I would say almost 30 years, it was a one-way street for private banks where they kept winning market share, wallet share, and they continue to win over public sector banks in India. But things seem to have changed in the last 5 6 years. Maybe because like the NPA problem got resolved to some extent for PSU banks, and their service standards improved, and so many other things which you probably know. But how do you see this going forward? Like, is something which is a fundamental change or transition which is we are seeing, or what's your take on this, Pankaj?
So I think this is a myth that public sector banks have been consistently losing market share from 90s. So if you look at data, they did lose market share between 1994 to 2004. But if you look at data from 2004 to 13, in fact, they gained market share again bit, right? And then from 2013-14 onwards, they again started losing market share. And this was a massive market share loss between 14 to 23-24. And now in last, I think 1.5 year, they have again kind of, stabilized the market share or started gaining market share. So one theme, common theme in these 3 decades is that whenever they have seen asset quality pressure, they've lost market share. And that's true for anyone. If a bank sees asset quality pressure, it takes hit on their capital, their ability to grow, and it takes them like they I would say, I mean, it takes them at least 4 5 years back, if any bank goes through asset quality issues. Like, for example, forget about private sector banks. ICICI Bank used to be bigger than HDFC Bank till 2008, much
Right,
bigger than HDFC Bank.
right,
Not a lot of people know it.
right,
It was only in 2010 that HDFC Bank surpassed ICICI Bank.
right,
But because ICICI Bank struggled with a lot of asset quality issues,
right,
their growth was very patchy, 2%,
right,
sometimes 3%, then again 15%. But HDFC Bank consistently growing at like 16, 17%. They overtook ICICI Bank. So Yeah, so as I said, one is the asset quality issue. So right now, because asset quality is quite good for PSU banks, my sense is that this trend should continue. Second, I think some of the issues which were there with PSU banks in terms of technology, like ATMs, or I would say transactional capabilities, quality of service. Clearly, I would say it is, I won't say it is still anywhere near private sector banks, but they've improved a lot in a lot of these other services. So I would say that I'll put it this way, it won't be that easy for private sector banks to gain market share from PSU banks the way they did between 14 to 23. They still marginally grow faster than PSU banks, but not the way they did, in the last decade.
I think that's very helpful because I think a lot of people, as you rightly said, that like the phase between 2004 and 2013, it was not the case that
Mhm.
PSU banks were losing market share. And thank you so much for correcting me. But I think if you look at how this thing is at present, is it a good thing that like the competitive environment is much more favorable for customer, or we would say the end users? Because if one particular segment of banks, for example PSU banks or private banks, is in a more of a difficulty, then probably that will not be a good time for customer. But today, do you think there's something which is very, very good for customers because how these banks are placed, PSU banks and private banks or the sector in general, it's a good thing for it?
Of course, yeah, it's a good thing. I mean, let's look at mortgage rates. I mean, somebody like you and me can borrow at a cheaper rate than most of the state governments, from from banks, right? So
That's amazing.
yeah,
That's
right.
amazing.
I mean, if you look at car, if you look at any product, right, be it car loans, personal loans, the spread over home loans used to be quite high, like 15 years ago, 10 years ago. I would say that the spread of personal loan over home loan, it is one of the lowest in last, or lowest ever, basically, right? So clearly, more the players, better the service or lower the pricing for the customers, and more the innovations, right? So from that perspective, I think it has been a good. I would say right now, Indian banking is in a very good shape where there are different kind of players, all are healthy, all are capital stuffed. It's not like anybody is short of capital. There are some, fintechs, there are NBFCs. So yeah, I would say it's a for a consumer, it's a good time to be a banking customer.
I think you mentioned something very interesting, like the spread between a secured loan and unsecured credit, and the way the consumption patterns have changed. Maybe like some people would say because of Gen Z, or some people would say because of COVID. Some people would say that like this is how the outlook has changed about spending and saving. But a lot of people are also concerned about this excessive growth in unsecured credit, and people say that like for example, personal loans, you think it's a challenge, or we might see a blow up sometime soon? Or of course, exact timing may be difficult to forecast, but do you think it's an area of concern or not really?
So this, if you look at purely, let's say your personal loans plus credit cards, these loans as a percentage of total loans or as a percentage of GDP, it's not like it's very high. In fact, we are much lower than a lot of developed countries. We are much lower than some of the developing countries as well, right? But of course, the growth has been very, very high. Especially last 5, 7 years. And question is that whether incomes can keep pace with the growth in the loans, right?
Right.
So I mean, even like whatever personal loans, credit cards we have as a percentage of GDP, even double of that, might be healthy as long as people have their incomes growing, salaries growing, jobs growing, right? Problem comes when these things are growing and people are not able to serve it, and that's where I think the key thing to watch out for is not, of course, the growth has happened. How the overall job market behaves in India, right? Where the job growth continues, whether we see some issues in jobs because of whatever, because of tariffs or because of, what this H1B visas or whatever, right? If it impacts jobs in one way or another, then definitely, it impacts, credit quality in these personal loans. So that is one thing. Second, of course, banks and fintechs, I think to some extent they overextended, in the risk curve in the last 3 4 years. They experimented with a lot of new things, that okay, I can give this person based on how much he's spending on his app, or how much sales any consumer is doing on, or not consumer, any shopkeeper is doing on his app, right? So a lot of new experiments have happened. Underwriting has happened in the last 3 4 years based on alternative data, right? And that's where I think the risk might come from these models because they are not tested yet, right? I would still say that the core portfolio of banks, because banks have been in this business for last 15 20 years, they know their customer quite well. Like if I have my account with HDFC Bank, apart from knowing where I'm spending my money through GPay, they also know that, right? Because ultimately my money is moving from, but they also know how much salary I'm getting, where else I'm spending my money, right?
Right,
But
right, right.
somebody is giving money only based on, how much I'm spending on my GPay, or, I'm not saying that's a bad model, but the point I'm making is that these models are still not tested, right? Because there is not enough data, to test these models, right? Even statistical models are as good as, how much data you put into these models.
I think that's a great point because I think I completely agree that the kind of customer data you have, and for example, as you rightly said, like if you have an account with a particular bank, they will know you much better than somebody else. And that's where the difference comes in terms of how the quality of customer is, how the quality of the loans you extend to a customer
Agree.
is. And I think that's a great point. I think that's also an important point in terms of how this thing will evolve. So I think thank you so much for highlighting that, Pankaj. We'll move on. I think in terms of like a lot of people would be interested in knowing your view because of your interactions with the investors, which you do on a day in and day out basis. How do you think today the investors, like if I classify, let's say, domestic investor, foreign investors, and investors in general, institutional side, how they're seeing the banking space today? Of course, you don't have to take names, which banks are liked or not liked, but how you are seeing this? And for example, like are domestic investors more long term in their approach, or how foreign investors see this entire thing? What's your take on that? Because that's something which is very interesting. A lot of people would be interested in knowing your perspective on that part.
So relatively, I would say that FIs have more interest in banks compared to domestic investors. Reason being that most of the FIs, they want to play domestic themes. They want to invest in the companies or stocks which are directly benefits from India, domestic consumption story. And banks are one of them, right? They won't invest into oil and gas or metals, in India. They have a lot of other revenues, other countries where they can invest in these commodities. Compared to that, for Indian investors, there is a cap how much they can invest in one sector or one stock, right? So purely because of that, you'll see, that you will notice that, HDFC Bank or ICICI Bank, some of these banks have disproportionately higher FI ownership, right, compared to
Right,
other stocks.
right, right.
So yeah, that's one. And within banks, I mean, yeah, generally HDFC Bank and Kotak has been perennial favorites. During when I was covering, when during most of my career, I think HDFC Bank was perennial favorite, followed by Kotak. ICICI Bank, of course, till 2008, it was loved by everyone, but after 2008 till 2018, 19, it was out of radar. But I don't cover the sector right now. But when I last covered the sector in February 2025, ICICI Bank was way ahead of HDFC Bank. So surprisingly, or not surprisingly, I mean, given their performance, ICICI Bank was the favorite of all the FI investors. Of course, HDFC Bank lost some space because of that merger and few issues in last 3 4 years, and Kotak to some extent lost that space because of stock not going anywhere in last 4 5 years. But yeah, generally they have been larger banks, and we have also seen them bit interested in larger NBFCs. So yeah, I would say relatively FI being more focused on banks compared to DIs. I've had more discussions with FIs on banks than DIs, I would say.
Right, right, right. I think that's a good point because, like as you said, uh, not just markets are cyclical, but investor preferences are also cyclical because there are times when the sector preferences will flip, and you can only sense that in retrospect and see that, okay, this is the point where the preference changed. But I think that's something which is always important to keep in mind, not just in markets in general, but also in terms of the sector preferences investor have. I think you talked about something which is very interesting about fintech, and there are a lot of talk about like the disruption which might be caused and potential changes which might happen in the sector. And there could be so many angles like technology, uh, customer preference, the behavior part, and launch of new products or services, all that. Like, how do you see this evolving, and where do you think that probably things might get more interesting in terms of how this entire sector will change? Because a lot of talk has already happened in terms of how the new age fintech especially will disrupt the sector. But I would say that a lot of people are also concerned that there was over promise and under delivery on that part. So how do you see that, Pankaj?
No, I mean, I would say there was no overpromise by the at least banks. I mean, it was more a hype created by media and some part of the investor community. Because this, I think, a lot of people took cue from China. Alibaba, Alipay, or Tencent. But the structure of Chinese banking is a bit different from India, where they never had something like UPI, where you bank to bank transfer, instant transfer. So UPI basically nothing. I can transfer you money instantly from my bank account to your bank account, right? Was a very unique technology. Very few countries have it, right? Now China, because they were behind this technology, Alipay created that wallets, right? So you take money out of from your bank account, you put into your wallet, this Alipay wallet or WeChat wallet, and then you pay from wallet to wallet, right? So the money leaves banking system and it never comes back to the banking system, right? Banks have no clue, right? What's happening to that money because that's just moving within Alipay wallets, that's just moving within WeChat wallets, right? And on top of that, they created a lot of products. If you look at the success story of Chinese fintechs, because the banks were completely in dark in China.
Right,
Once the money left their account, only when the finally somebody redeemed that money, from their wallet, they saw it, right? In
right,
between, what happened with that money, they never. Uh, in India, Paytm actually tried to do the same thing earlier. That was the idea when they introduced those wallets. But UPI, to some extent, I think killed that model, right? Now, even if you are paying through GPay, at least SDFC, as I said, SDFC Bank knows it, right?
right,
So
right,
one thing very clear is that we'll not go China way as far as fintech disruption is concerned. Having said that, of course, just see, ultimately, you notice one thing that banks not only dominate lending, but it's not surprising that top five mutual funds are bank sponsored. Top five insurance companies are, sponsored by banks. Most of top general insurance companies are also sponsored by banks. Even top brokerages, stock brokers, they are also, ICICI Securities. So a reason is that because they have distribution and they have the customers, right? These are the two things which because of which they have nailed every financial services business.
right,
Now that's where this technology and fintech might change things because, for example, earlier why? Because if you want to do any banking transaction, you used to go to the branch or you used to go to the bank website, right? Now I don't think I hardly go to my bank's website. I do my lot of my transactions through GPay. Now, if you open GPay and a lot of your products are available there, right? Some small
right,
insurance or small FD,
right,
you'll start buying from GPay itself, right?
right,
So that's one thing that product distribution, a lot of those things, these fintechs who are at the front end, who are customer facing, right? They will take some slice out of this whatever pie which entirely was with banks.
right,
Clearly that is one thing. That's why you could see that broking, I mean, Zero Dha, Grow, they've been able to, I mean, yeah, they are number one and two, right?
right,
They, and now because people are spending time on Zero Dha and Grow app, and they have opened their mutual funds as well, right? And that's
right,
why within no time Zero Dha has 9,000 crore AUM, right? So yeah, ultimately, I mean, banks will not get completely sidelined. I don't think because they are the capital providers, and the way banking is structured, that capital and lending, ultimately the credit creation can only happen through banks.
Right.
It's a slightly complicated subject. I won't go into that. So banks will always be there, but all this value added, distribution services and everything, I think banks share, in my view, gradually might come down because the distribution advantage, the customer advantage, that will slowly, I think, will go down. It's not a 1 or 2 year thing, but in a long way, I believe that in a lot of these peripheral things, banks might lose market share.
Thank you, Pankaj. In fact, I was just scanning through the Q&A window and I
Mm.
noticed something very interesting. There is a question. Of course, the person has not given the name, anonymous attendee, and they have asked, "What is your current salary?" And immediately there was a response from Meet Maru. Please ask questions related to the webinar topic and let's go to the topic. I think that's amazing. But
I can tell that audience that of course if he becomes successful in sell side, yes, salary would be enough to brag to your friends actually.
but yeah, I think we are not getting into personal data and
Yeah.
like stock recommendations. But I found this really funny, so I thought of sharing this. But thank you, Meet. I think you brought the discussion back to the topic, so thank you so much. Let's again, like I think one or two more questions which I'll have, and then probably we'll have the questions from the audience. One thing which a lot of people talk about that how you also touched upon this, like the banks have that distribution muscle and they have the capital. And you think that like overall, when you think about distribution, there is a lot of focus on creating new products, innovation, and that is something which a lot of people talk about. Like it might get more complex, and that could be the impact on banking stocks. And you have covered that in some part. But anything further you want to add there in terms of how this thing will evolve? Because I think one thing is very right. Like banks, they're like they have their capital, they have the distribution network. A lot of people can come in and disrupt that, not in a big way, but in a small way, but that is enough for them to create enough value for the customer or the value or the investors which they have, and even the entrepreneurs. So like how do you see that picture?
So as I said, at every product, like where everything was concentrated around banks, slowly a lot of these things will get the cliched but unbundle in my view. So for example, like if you want to put deposits, right? So earlier you put your deposit directly to the bank, right?
Right.
Now if you open GPay, you'll find options that where you can open deposits through GPay, right? Now your GPay will take some cut in that deposit, right? So that's my point, that in every product, right, there will be a lot of choices. They will get unbundled, and a lot of these products will be available at the point of sale or at the point where customer is going for whatever reasons, right? Let's say if he's going to make my trip, so you'll buy travel insurance from there, right? It's earlier, let's say you, even for travel insurance, you used to go to your relationship manager at HDFC Bank or, wherever you have branch, right? So in a way, as I said, apart from lending, where still because of capital and everything, banks will have a dominant role in a lot of these other products, right? There, I believe that there is a lot of scope for disintermediation, where the fee pie, I would say, in my view, is that will be distributed amongst various players over the years.
And let's
Mm.
talk about this, which probably a lot of people would be interested in. When you look and analyze a banking stock and you are evaluating it as an investment opportunity, which are the key things you should keep in mind? For example, like numbers you should focus on, and even things like comparison with other stocks, and things like news flow analysis, management quality, governance, etc. So, like, and any views on that? Because you have done it for so many years that, like, I would say that your insights would be very, very useful for the audience.
So I think while analyzing a bank, I think I would say if I'll drill it down to only three things basically, right? Of course, and then you drill down further. So if you tell me this will be the return on equity of this bank for next 20 years, if you give me that number, if you tell me the growth rate of that bank for next 20 years, I mean, these are the only two numbers I need, right? Return on equity and growth, right? Growth is your reinvestment rate, and return on equity, how much return you are getting on your capital, right? These are the
Right.
only two things which matter, right?
Right.
And of course, sustainability of these two numbers, right? Right. So that should be the starting point, right? How much is the long-term growth potential of this bank, and how much is the return on equity this bank will earn, right? If it's a very high ROE, high growth business, of course, the returns will be very high. Bajaj Finance, HDFC Bank, you would notice were common characteristics: very high growth, very high ROE, right? Uh, then, of course, there might be some businesses which are high ROE businesses, but growth is not very high, like Muthoot Finance, right? Very high ROE business, but growth has been very patchy. Sometimes growth is hardly 5%, sometimes it's 15%. So it will get slightly lower multiple because you earn higher ROE, but you can't reinvest that ROE, right? So, because of that, that book value compounding will be at a slower pace, right? And then, of course, there might be some businesses with initial low ROE but high growth. In such businesses, the assumption is that ROE at certain point of time will go up. So market gives them benefit of doubt initially. So startup banks, some of these small finance banks, but ultimately that ROE has to catch up actually. Once that business reaches at a certain scale. But if there is low growth and low ROE business, clearly, as an investor, I'll be, and of course, at a certain price, everything becomes buy and sell. That's a different thing. But from purely from a business perspective, if a business is sustainably delivering ROE less than its cost of capital, it's destroying value. So yeah,
Right.
that was
Right.
the starting point, and then you drill down further that, okay, what drives this ROE and what drives growth, right? Of course, then, it starts with, okay, ROE, you prepare the DuPont tree, your net interest margins, right? And then, of course, net interest margins is your cost of funds. Then it goes into various factors. Basically. It's a very, it becomes then complicated. But as I said, ultimately it boils down to only these two or three factors.
Right.
Now, if you ask me that, what two or three factors which we should look at, to analyze that long-term, growth and ROE. Of course, one I would say is that your quality of management. As I said, it's a processes system. It's not a product where you have any, you have a pricing power, right? It's not like HDFC Bank can charge you 50 basis point higher on a home loan, right? It can't,
Right.
right?
Right.
Or the right. Your process and systems have to be very, very, very good. Sorry, I starting with quality of management, right? Because quality of management, that's where, it comes to everything. They set up process and systems. They set up the credit criteria. And that execution of, those, whatever, how the process should be run, how the credit should be given, that differentiate a winning bank from a losing bank, because there is no patent. I mean, you launch a product and tomorrow your product will be copied here, right? And that's where, my starting point for any bank is the quality of management. And quality, it's a very, how would you do that? Of course, it's a, you try to understand their incentive structure, their background. It's not that easy. I mean, that's where the experience comes, your ability to read the people. Of course, then you look at the entire processes and systems, whether there are proper checks and balances in the bank in terms of, how the credit is dispersed, whether there is a proper underwriting department or not. So I won't go into those traditional matrices, name everything, because they could look good for 1 or 2 years, right?
Right. Right. Right.
I can tell you, like, banks which have gone bust, just before they went bust, all the matrices which people talk about, they look quite good just even before they went bust, right? So as I said, the underwriting process, the quality of management, the low cost of funds, because that one advantage which nobody can take away from you.
Right.
These lot of softer factors. I would say that, P&L could be misleading for banks, for many years. In
Right.
fact, banks which have gone bust, their P&L looked very, very good for many years, actually.
Right. So true. So true.
Yeah,
So
yeah.
true. Thank you. I think this was extremely useful and insightful, Pankaj. I have so many other questions which I had, but I think there are like too many questions in the Q&A queue. So I'll just straight away move there. There is a question from Anil Tulsiram. And the question is stress in micro lab
Hmm.
ticket prices less than 5 lakh seems to have started from last quarter. It's a very specific question. Five
Okay.
Star and Equitas are reporting stress. In your opinion, how deep is the stress in micro lab? And secondly, what's your opinion on over leverage for subprime customers? Are there any indicators apart from number of loan lines per customer to measure over leverage, or anything you want to say on this, Pankaj? Very specific question, but very good question, I would say, Anil. Thank you so much.
So you see, Anil, as I said, I last looked at the sector in detail in February 2025. But when I last looked at, and I'm looking at the numbers, I looked at the recent numbers as well. My view was that lower end of the pyramid, or of course at the higher end of the risk curve, there is a leverage built up. It's not only micro lab. I think it's across the products. And the last report which I wrote on the sector, my view was that rather than product, it's the customer segment issue. So the general perception in the market was that it's a unsecured loans versus secured loans. And my call was that it is not unsecured versus secured. It's the subprime customers versus prime customers. So prime customer of HDFC Bank, which has taken personal loan, unsecured personal loan, will do better than a home loan or a lab customer subprime of an NBFC, small NBFC. So that was my view. And clearly, if I look at last 4, 5 quarters, 6 quarters, we started with microfinance. We have started seeing pressure in some other product categories as well. And if you look at the data, even the last quarter data, there is a clear distinction that smaller banks, especially this new age banks, small finance banks, and NBFCs, they are seeing more pressure on asset quality compared to larger banks like HDFC Bank, ICICI Bank, SBI.
Right, right.
I won't make a comment on how far it will go, because ultimately it's an outcome of what happens in the economy.
Right.
But as we know that the economy has been under pressure for last 3, 4 quarters, and if this tariffs and all this, whatever is happening at the global level, if it continues to put pressure on Indian economy, job creation, then yeah, my sense is that we are still at the beginning or mid of the cycle. It might extend further. But yeah, ultimately it will be a function of what happens in the economy. But if you ask me to take a guess, I think my sense is that yeah, stress might go up further in these.
I think it's a great point. Look at customer segment and not the product. I think that's a very good insight. Thank you so much, Pankaj. There is, of course, no discussion is complete without AI today. And there is a question from Madhur Gundecha. It is said that AI could improve the productivity of financial institutions a lot. Do you agree with this? And how much could be the impact? Could this also result in some re-rating of banks due to operational efficiencies? And could these savings be significant? Like, what's your sense on that?
See, AI is a new buzzword, but yeah, ultimately it's technology, right? And banks have been using technology to improve their processes and systems for many years. So, for example, back office, banks used to employ a lot of back office people, like when you used to apply for a home loan. If you remember, you used to fill a form and we used to give that form, right? And there
Right,
is to back office, which is filling all these details in the computer, right?
right,
This was automated in last 3, 4 years, right? So that's why you notice that number of employees in banks have not gone up in last 4, 5 years. If you tally, employees for, even if it has gone up, it has gone up in sales. In
right,
fact, your back office kind of employees, the number of employees have gone. Your branches, size of the branches have come down. ATMs
right,
have disappearing. In fact, number of ATMs are coming down for last 3, 4 years.
right, right,
So
right.
I won't use the word AI, but yeah, of course, technology is definitely will bring efficiencies for banks. It will definitely, I would say, it will make it easier for a new entrant to create a business compared to, let's say, 10 or 15 years ago, because you can bypass that distribution hurdle, or a lot of that distribution hurdle or employee hurdle, right? You need to hire a lot of employees.
Right. That's a good way to look at it, like in terms of like how easy it is or difficult it is to start that business and scale it up. But again, another question on this is from Abhiru Bhattacharya. First of all, he's saying thank you so much for the wonderful insights. How do you see the role of AI-based alternate lending models, and do you see subsidized loans for MSME in the future, or like anything of that sort? Could you see that potential and possibility, Pankaj?
So just see, ultimately, just see how when a bank give loan to a person, right? It is definitely based on the risk. They assess the risk, right? The reason, like, some people get home loan at a very low rate, right? And then, when less you know about the customer, more the rate you charge, right?
Yes, yes,
Right?
yes, yes,
Clearly,
yes,
that's how it works, right? So
yes.
if AI or all everything is nothing but, basically, how much more you can know about the customer, right?
Exactly.
Right.
Yes. Exactly.
Now, the question is that it will all depend on what data is fed to these models, basically, right?
Right. Right. Right.
The problem is that, data availability, in my view, is still, limited. I mean, for example, somebody, a street vendor, for example, right? Apart from his, let's say, like what the sales is doing through Paytm, that QR code, right? For that itself has enabled him to get some loan, right? But as I said, more and more data is fed into the system. Models will evolve and they will become better, right?
Right.
And AI is nothing but, let's say, for example, manually you'll think, okay, this district, this kind of customer, this age profile will default more, right? Earlier, it used to take a lot of time to do those calculations. Now
Right.
AI will just make it, very, very quick, right?
Right. Right.
They can run various permutation combinations and everything, right?
Right.
So
Right.
in a way, yeah, of course, it will become easier for banks to assess, customers, and in a way, worthy customers will get loans at a cheaper rate. I mean, this should
Right.
happen actually.
Right. There is an excellent question from Virat Vibhu, and Virat is asking, how do you feel about deposit mobilization? Is there a challenge now, given broadening and deepening of capital markets, and especially the retail investors getting more and more active in equity market? What's your sense, Pankaj, on that?
So first of all, it's again a myth that if you put money into capital markets, it impacts deposits. Uh, but banking deposits have nothing to do with whether you are putting your money into real estate or capital markets. Just do a thought experiment, right? Let's say I have a deposit, right? I have
Right.
a deposit, and I want to put that money into stock market, right? So what I'll do, I'll withdraw that money, and I'll buy and that money will go into the seller's bank account, right?
Hmm. Right.
So,
Right.
so my deposits. So I don't know from where this came. I mean, capital market investments are nothing to do with deposit mobilization. Deposits are a function of actually money supply in the system. And money supply is a function of three things: credit creation. So loans themselves create loans. How much new loans are given? Second is how much foreign money is coming into India. So every $1 billion when it comes to India, it gets converted into equivalent amount of rupees which come
Right.
into the banking system.
Right.
And if every $1 billion goes out of India, it extinguishes equivalent amount of deposits. And third is that where Indian government keeps its money. If
Right.
they are keeping their money with RBI, that money is not part of banking system.
Right. Right.
If the
Right.
same money they are spending, then that money is coming into the banking system.
Right.
So, right, the deposit, what you are seeing, it is more a function of money supply in the system. It is nothing to do with capital markets.
Right.
One thing I can tell you for sure, that if I want to take a bet on Indian banking for next 5 years, 3 years, 10 years, deposit growth is you don't need to worry about that. If there is lending opportunity, deposits will be created automatically through that lending
Right.
actually.
Right. Right.
Right.
I think we go back to the same point which you said, right? It's not that the deposit is a problem. It's a problem where the credit
Right.
is
Credit
an
is
issue, right? If you don't have
credit.
the enough opportunity there, then there will be a challenge. But I think, thank you. This was fascinating to hear. I think this
Yeah,
is
there is
very
a
interesting.
yeah. There might be some mismatch somewhere. I'm not saying that it's always. It's not like one bank. So when I'm talking about that, that's at aggregate level.
Right,
Now,
right,
some banks might see, that they create the deposit through giving a loan, but that money is not stuck with them. It goes to some other bank. So
right, right, right,
that's then comes the bank's individual capacity, right?
right, right,
Individual capabilities. But at an aggregate level, capital markets investments are nothing to do with the deposit mobilization.
right, right. There is a good, very, very interesting question from Praveen S. And he's asking, compared to PSU banks, how competitive private banks are in rural areas, in rural economy. Is there a difference? And is there anything which you have to say on that, Pankaj?
Yeah, so I mean, of course, the private banks wherever they've gone, they become competitive, right? They are competitive, right? So it is all about competitive in the sense pricing. PSU banks have always been better. I mean, even if you take a loan, I would still say that public sector banks, offer you cheaper loans, right? So a lot of my friends who work in public sector banks and private sector banks, and those who work in rural areas, they clearly say that given a choice a customer first will always first goes to PSU bank and take a loan because it's cheaper, right? And
Right,
no, there are not a lot of charges here and there, right?
right, right,
Problem is that the delivery, the quick delivery of the loan, right?
right, right,
That's where problem is that, the borrower has to go through a long process to take that loan, right? And given, the nature of financing where, he needs it very quickly, that's where you could see that public sector, private sector banks or NBFCs, they are very quick in their, loan delivery. And that's why they've been able to capture market share. But now that's why you would notice that a lot of public sector banks have started talking about TAT, turnaround time in their
right, 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 right,
presentations
right,
because they've realized that pricing is not good enough. It has to be your delivery time also has to be good. But yeah, to answer the questions, yeah, definitely private sector banks are entering into those areas because urban areas are now already saturated. So definitely they will become more competitive.
right. Because we are very close to our closing time, but I know it will be a grave injustice to all the people who have sent us their question. But one last question I will take is from Arakai Prayan KN. I hope that I'm pronouncing the name well. But the question is very interesting, and it's something I also wanted to understand, Pankaj, from you. Uh, and what the question is that, speaking about capital adequacy ratio, uh, of course, the person is asking that his or her banking prof critiqued that the
Hmm.
Basel III norms didn't affect the financial institutions who were actually responsible for global financial crisis in 2007, 2008, but it rather affected only banks. And do you have anything? It's very interesting and might be a little controversial as well, but anything to say on that, Pankaj, from your side?
So see, we have to first understand, what is capital adequacy, right? I mean, yeah, and because it's the last question, I'll take slightly longer time to answer because this is fundamental to banking, right? So, for example, I am a bank, right? And what I do, I take money from you and I give it to, let's say, Harshad, right? Okay, and I don't have any skin in the game. I just take it from you and give it to Harshad. So what I'll do, right? And Harshad, let's say I'm taking it 7% from you, and Harshad is paying me 9%, right? I'm making 2% spread. Now suddenly, Abhishek says that he'll give me 10%, or Urav says that he'll give me 12%, right? So I have the tendency to give it to Urav, right? He's giving me 12%, 5% spread, right? Instead of giving to Harshad, I'm making more money if I give the money to Urav, right? I'm making 5% because अगर पैसा नहीं आया तो आपका जाएगा, right? I'll say कि sorry Pankaj Sharma ji, I lost money. So that's where, this capital concept came, right? This is how it was introduced, that the bank shareholders should have they should take the first hit. If the borrower does not pay money back, then, I mean, the bank shareholder should take the first hit, basically. That is the concept behind, you know, Now, over the years, that was a concept. This entire concept got diluted, where they introduced tier one bonds, tier two bonds, and that bonds, everything. And if you look at the 2008 Lehman crisis, this was the genesis where the risk was too much, but the capital to support that risk was too low. A loan which was given to, let's say, sorry, Urav, I'm making you a higher risk category, but let's say given to Urav at 12%. But through whatever financial jugglery, it was made to look as if it was given to you at 9%. AAA, all those subprime tranches were converted into, AAA tranches, right? And that's where then Basel III came and they said that, hey, all this is bakwas. Now you need to have your own share. That's common equity, CET1. This is called CET1. You need to have your own CET1 capital ratio of this much. Then need to have additional this much capital. So clearly, they have put a lot of checks and balances where your own capital, but the money you lose if you make any mistakes, that proportion has clearly gone up, in the last 10 years, right? I've clearly seen it in the Indian banks where, when I started, the leverage was 20 times, housing finance companies used to have tier one ratio of 6% basically. Like somebody like LIC Housing Finance, SDFC used to lever their balance sheet 15, 16 times. Now no NBFC can leverage its balance sheet more than 7, 8 times. Even banks, best of the banks, maximum leverage is 10 times. PSU banks can go slightly higher because they do a lot of this low risk assets, right? So mortgages where the risk weights are lower, G6 where the risk weights are lower. So I would say that I don't know, but in my view is that Basel III has clearly strengthened the capital structure of the banking system, and that's why if you see globally, in fact, banks are lobbying against this capital requirement. They are saying that it has killed their business model. ROEs have come down because apart from capital, even the lendable resources have come down because they need to give a lot of that money into as liquid assets. So I don't know whether is professor said that it has further worsened, but in my view, in fact, it is improved post 2008. After 2008 crisis, in fact, the way regulators look at capital, it has completely changed for better.
Right. Thank you so much. I think beautifully explained, Pankaj. And I'm sorry about the fact that like so many questions in the queue from people: Charanjeev Singh, Saloni Joshi, Virat Vivu, again a follow-up question, Vinay Kumar, and two questions more from Saloni Joshi again, and then Chandrasekhar Bolu, Anil Tulsiram, a follow-up question, Harshvardhan Jain, Abhirup Bhattacharya, follow-up question, Harsh Agarwal, another question, Abhishek Hindocha, another question, Ivan Pankras, question from him, Gaurang Mehta. So many questions we have got. Krishna Tibrewala, Abhiru Bhattacharya, another question, Madhur Gundecha, Virat Bhivu, Tushar Singla, Harsh Doshi, Harsh Agarwal. So many questions. I'm really sorry to you people. I could not take all the questions which I had, but thank you, Pankaj. I think it was fascinating, beautifully explained so many of these difficult concepts. And thank you so much for sharing your experience with us today. It was insightful to listen to you, and I'm certain that our audience would have also felt the same.